How does a person vanish today? Not physically. How does someone slip through the cracks of a world tracking our every swipe, click, and transaction? The subject of this case was a government accountant, a man whose entire career was built on data preservation and meticulous record-keeping. When he went missing, he left behind no body and no physical evidence of foul play. More disturbingly, he left no digital footprint. His bank accounts, his tax records, even his employee ID, gone. Investigators initially operated on a logical assumption. Given his deep technical knowledge of financial systems, they believed he engineered his own disappearance. He wanted out, and he knew exactly which servers to wipe to ensure he could never be tracked. Then forensic accountants found something buried in a hidden partition directory on a government server, a single heavily encrypted data fragment, a ghost in the machine. When they cracked that fragment, they didn't find a suicide note or a new identity. They found a complex data mining log linking a network of offshore shell companies to a series of off-the-books ledgers holding billions of dollars that officially did not exist. This demonstrates a concept in forensic accounting called the expectation gap. Standard audits look for simple errors, missing deep-seated criminal fraud on a secondary layer. The accountant looked past top-line numbers, exploiting this gap to see hidden nodes. These offshore accounts and phantom billions indicated he was running from a specific number, one that revealed a massive, lethal conspiracy. To understand the exact mechanics of what he found, we have to look at the framework he was auditing against. This document is the official UAE guideline for countering money laundering and terrorism financing. Section 2 outlines the strict requirements for risk identification. Entities are legally bound to document their exposure to money laundering and terrorist financing. The accountant noticed the internal risk logs for certain high-value government accounts were completely blank. He mapped these blank accounts against government typologies. Case Study 4 explicitly outlines how corporate structures are misused to launder illicit funds. The accounts he found hit every documented red flag: indirect financing, obscure corporate intermediaries, and completely ambiguous ownership. Mapping these red flags against the secret ledgers suggests a level of system access and coordination that goes beyond typical corporate fraud. To bypass these specific federal controls required more than just money. It required a presence inside the administrative architecture itself. The investigation then moved from the hidden money to the human beings attached to it. The accountant's logs showed he had started tracing the beneficial owners, the actual people hiding behind the shell companies and intermediary accounts. A chilling pattern emerged in his notes. Every time a multi-billion-dollar transaction cleared the final ledger, the individual listed as the beneficial owner vanished from public record. As the pattern locked into place, the accountant realized the digital networks were compromised. He began frantically printing physical ledgers, pulling hard copies of everything he could find, and building a massive web of connections on paper. He could only trust the physical evidence. This discovery led investigators to the suicide protocol theory. Realizing the people tied to these massive transfers were disappearing, the accountant feared he was next. He used his deep system access to systematically erase his own history, hoping to become a ghost before they could find him. In a modern society, our existence is tethered to data. Our property, our movement, our identities, they live on servers. Being completely erased from that digital network is effectively the same as being murdered in the physical world. You cease to exist in any way that matters to the system. A final decrypted file from the accountant's hard drive dismantled that theory completely. It contained the system access logs for the day his data was wiped. He was not the one who initiated the erasure protocol. The file proved the existence of a mechanism the syndicate called history laundering. This diagram shows the systematic deletion of a human being from both public and private databases. Birth certificates, tax filings, property deeds, all systematically blinked out of existence to sever the asset from the owner. The accountant was a whistleblower. Following his discovery, the syndicate initiated a total scrub of his digital identity, ensuring his findings would appear to be the work of a phantom. With his digital profile purged, the legal machinery used to verify witnesses and evidence has ground to a halt. In a system where the digital ledger is the final authority, His absence from the database creates a procedural void that makes prosecuting the syndicate nearly impossible. We trust the data that verifies who we are. Our entire modern identity depends completely on the integrity of a master ledger. If an accountant can uncover a discrepancy and be systematically deleted from reality, the question is no longer where the money went. The true question is who controls that master ledger right now, and whose name is currently being erased.